We know there's going to be a run above these equal highs. By itself, that's enough. We also anticipated a run above the daily highs that made the equal highs at 95.53, as I just shown you on the daily chart. So how do we get to 95.65? Well, we're going to incorporate a couple of things here. I want you to look at the daily dividers here with our 20 and 4, which is going to be our midnight and beginning point for the central bank dealer's range. Okay, so inside that range, I want you to focus on these two price points, because those price points, seen with this body's high and this body's low, okay, because we're focusing on the volume, okay, this is the lowest opener close and highest opener close in the range. Okay, so we're using that to frame out our standard deviations and intraday projections. So we have our 95.53 level on. We have 95.40 as shown here. So we're looking for several reasons to go above 95.40. We have equal highs from the 18th. Then we have the 95.53 equal highs on the daily chart, and also anticipating that run off of the 94.30 low anticipated for the dollar's price range relative to its weekly chart. If we look at the projection of 95.65, that actually comes to 25 pips above the 95.40 equal highs. So it's not a range sweep of 10, 20, or 30 pips above the equal highs at 95.40. But think about this for a second, okay? Because this is how I did it. If we know that the equal highs on the daily are likely to be swept, okay, and prices below that level here, okay, so as we entered into the 19th of July, we're looking for a reason to go up to sweep a level that is defined at 95.53 relative to the Forex LTD demo count. Okay, so if the expectation is that we're going to go above that 95.53 level, what can we do for calibration? Do we use the 95.50 level, which would be below it, or do we round up to 95.55? Or 95.60? Well, if we're below price and we anticipate price wanting to sweep above it, then it's natural for us, if we're looking for price to want to make a run above that 95.53 level, then it's natural for us to want to take that level and round it up to the nearest 5 or 0 level. In this case, it would be 95.55. Okay, so at 95.55, now we have our level that IPTA should reach for. Why are we rounding it up? Because I know sometimes I teach that you want to round down to get to the objectives. Not down in the sense that directional, but in terms of the range. We want to go to the smallest potential range. But if we're going to be running highs, okay, you want to be looking for the potential swing that will go above it. In this case, we had 95.53. So my thinking was, well, if it's going to go up to 95.53 with the expectation we're going to reach for stops, then I'm just going to calibrate my range to 95.55, as you see here. Then we can start looking for stop sweeps of 10, 20, and 30 pips above that. Well, above 95.55, what's 10 pips above that? 95.65. Okay, 95.65, a 10 pip run above this high. So if we take that, we get the actual high of the day at 95.65. Now that's what I was anticipating in here. Okay, as we were running up, I was watching these equal highs, but because we have the daily equal highs delineated with 95.53 that we now calibrated to 95.55, because the expectation is we're reaching above it, Okay, so for completeness sake, if we were in a bearish scenario and we were looking at, say, for instance, a level of 94.97, okay, and we were above price and we're reaching for it to go lower, anticipated a sweep, what would we use in that regard? 94.95, okay, because it's going to be a reach below, so basically calibrate our level to the nearest 5 or 0 level. In that case, I'm giving you the opposite end of how we can use this, or the different side of the continuum, if you will. So we have these levels in here as delineated with these arrows. So now what I'm going to incorporate is the intraday standard deviations, okay, using the range as explained in the mentorship. And you can see how we go up to 95.65, standard deviation of 4, and IPTA data range high of day, beautiful delivery, perfect, right on the mark. Okay. We also have the run of 10 pips above a calibrated level relative to the daily chart, which was 95.55 from 95.53. So again, the expectation is we are looking to reach above it, so we calibrate our level up. Okay. Now, if we are looking for a trade and we're long and we want to exit, then we would round down for our level of exit. Okay. The bulk of our position would be taken off early by rounding down. But when we're looking for a run on stops, we always expand the range, because the nature of that characteristic in a stop sweep is it reaches above an old high or it reaches below an old low. Okay, so you have to expand the range in that regard. So with the IPTA data ranges expanding up, okay, and the time of day, in here we have the New York Open. What day of the week is the 19th of July? I'll give you a little bit of help. Thursday. Okay, we have Thursday right here. So you have Thursday in a bullish week. It's gone up. So Thursday, New York session, what does the mentorship teach you? That there's probably going to be a reversal at the New York Open. I think that pretty much happened on Thursday. And we would run for the equal lows here on the 18th. We swept those, and then we went to consolidation. Okay, and if we go into our notes for the 19th as well, by adding that, you can see we have the IPTA projection on the low of the day, seen here. Okay, and again, we're using the range defined by the highest body and lowest body, and projecting that down, and we get our levels as seen here. Okay, so we have several confluences as taught by the mentorship, and especially price action model number 5. Also notice that because of the precision of this, we have the 19th New York Open. We have that level coupled with the Thursday day of the week phenomenon. So we're anticipating a potential market reversal profile in New York, exactly 10 pips above 95.55, which is a calibrated daily level, calibrated from 95.53. We have that overlapping with our standard deviation of 4. Okay, so we have that, and you're probably looking at this over here because I'm doing both. I'm doing 2 of them in there. The reason why I'm doing 2 is I want you to see the overlap of using the high and the low here on 2 different measurements. So you can see there's absolutely zero funny business. There's no making it fit type thing. And plus, I shared it on Twitter. I put it on there, so everyone saw it. There was no excuse not to see it. We also saw as the dollar index ran into this high, we anticipated a potential reversal as outlined in the mentorship commentary for Monday of this past week, and we got it. Okay, so that came to fruition as shown on the daily chart here, beautifully delivered. So at this moment, we're going to be looking for a run to the sell stops here and below here for the coming week. Okay, but I want to go over to the cable. Okay, and we have a virgin chart here, nothing on it, completely naked. And I'll add the daily dividers in here. Okay, we have the low formed on cable at the New York Open. Again, market reversal profile. Okay, so we have our standard deviation overlaid on the cable. And we have our level right in here. Lines beautifully with our low of the day. Okay, right there. Perfect delivery. The low on this particular candle comes in at 29.59. Standard deviation projection. Price has a reaction, comes back down into consolidation, and I'm going to zoom in right in here. Okay, and we're going to look at something in here, and we're going to talk about order blocks, calibrating bullish order blocks and the like. With everything I'm going to say, you reverse it for bearish order blocks. But before I do it, take a quick glance of the projections on the upside. Okay, we have relatively equal highs in here. See that? Very, very flat price action. The high comes in at 31.18. Okay, 31.18. And a run above that would be reasonable. Okay, so while we're down here, going into the new day, we also have the equal highs here as I shared on Twitter. So this is the one I shared on Twitter publicly. Then we have this level over here. And then we also have a very, very, very small little gap in here. And we also have a gap in here. Okay, see that? Let me zoom in. Okay, right in here. Notice this candle, we went up, closed, we gapped up, went up a little bit, made a small little body, and then was open and straight down. So there was really no price action to provide an up candle in here. We just had a bunch of wick. Okay, now watch this. We're going to put this level on. Right there. And the high, the open rather. Open on the candle is 131.41, exactly where it's laying at now. So we'll have that on our chart. So price, when we zoom in here, in this order block, down closed candles prior to this big run up, so we had displacement. Elephant stepped into the children's pool, if you will. So we have displacement there. We have a little gap right in there. The close, 29.98. And the next candle's open, 29.97. Okay, there's 1 pip difference in that. In this whole series of candles, normal free tutorial folks would take that and say, okay, these are all basically a single bullish order block, and they would mark off the mid-range of that. Okay, I don't do that here. I'm looking at that 1 pip difference, okay, and I think it's going to go to that price point only. Price comes down in Asia on the 20th and has a low of 129.96. Okay, 129.96 is the low, and the open, which is the bottom of that 1 pip gap, is 129.97. So we were off by 1 pip, but look at the sensitivity there. See that? It rallies up, clears the equal highs, and then trades right back down into this level at the open of this candle, and then we have a run. As price starts to rally in the London session, price reaches up into that gap that I just outlined outside of the normal range. Okay, so we were going back a little bit, looking for imbalances. Price goes exactly to 131.41. Okay, notice it's also standard deviation 3. And it's also a standard deviation seen. I gotta have to take that horizontal line off. There you go. So we have our projection here. Note the time of the day. It makes the high 1800. And you learned this in the free tutorial stuff. 1800 generally is like the last bit of the daily range, unless it's like FOMC minutes or something like that, where we can see some flurry of action around the 1800 hour going into bond close. But you can see a beautiful delivery of price action shown with the standard deviations, the overlapping from previous day. So IPTA is referring back to these same price points, folks. It's undeniable. You can see it. It's happening there. Also notice that we also have in the London session, we have another gap right in here. Okay, but the body opens. We wick down, but we leave that opening and that there's no body there. Okay, so as price starts to move away, price comes back down into what? The gap, but are we looking to fill the gap, or is it something else we have to look at? The order block to the left, that last down close candle. So now this is where we're going to use the open. The open is 130.07, okay? 130.07. The low on this candle comes in at 130.07. Perfect. Comes down, goes into what would be reasonable for the gap, but we're going to go right to the open. So why am I not using the wick here, Michael? It's because we're using this as a draw to rebalance, that we have to use the order block itself because that's where the actual IPTA array is going to be reached for. Okay, in other words, that's the data it's reaching for. That happens right here. Then we get that nice reaction immediately off of that and expands on the upside, reaching for the buy stops as indicated on Twitter. Now, I didn't give you anything on Twitter beyond that because if I give too many things on Twitter, it can be studied, and I was smart enough to figure it out too after seeing many, many examples of it, so I don't want to give it away for free. So we see the 131.41 level delivered relative to several different things in here, and I wanted you to kind of like go through your charts and look for examples of that when we have a buy that has an order block and there's a gap in here. Okay, watch how many times it goes to that price point. You ever seen an order block that has like its mean threshold violated but still doesn't go below the low of the order block? Many times you're going to find it has this event in here. Okay, so have that in your notes. I don't know when I'll talk about it again, but when it pops up and gives us an example of it, I'll certainly do so. But in your notes, you absolutely have to have this in your section for your order blocks because this is what makes me decide on whether or not I want to be buying at the open or the wicks high or selling at the wick low or selling at the open of the candle that would be a bearish order block. Okay.
Rhythmic theory. And it's a intraday short-term strategy where I introduce the standard deviations and such. And I give you rules in that model and when to pick the clout and when to pick central bank dealers range and when to use the Asian session. So we don't need to go through all that. That's already been taught. So I want to take you into a market, Australian dollar. This is our daily chart versus US dollar. And we're inside that seasonal tendency that was bearish. Okay, we're looking at the daily chart here. We have a nice up close candle and it's trading up into a breaker. High, low, higher high. Trades up into the breaker there. So we have a bearish bias and we have a up-close candle in a market that's expected to go lower, and we'll say it's likely to draw down into this area here in longer term, but again, we're just using this bias, or these relative equal lows here, as a means for determining the expansion where we're looking for. So we're expecting the next day to start working lower, but for intraday, where do we aim for? Well, we can start with this daily low. Okay, so we're going to look at that daily low as an objective for a short if we can get all the confluences. All right, so here we have a 15-minute time frame. I mentioned 15-minute time frame is kind of like the bellwether. So again, go through your model for model number 5, and you'll hear all that detail as well. But we're focusing primarily on a run below this low. Okay, so we want to know, can we get a setup that sets up a short that takes out this low, and how far can it go using model 5 precision elements with the standard deviations? So that's our pool of liquidity that we're aiming for. And obviously, with the benefit of hindsight, we can see it's over here. But we're going to put some math into it. Okay, so we're using the flout. And I went through all the rules. You can go through that for yourself. And this is what we're going to be utilizing. So we're using a high to the low. You always split that range in half, and then you can do your standard deviations set up that way. Or if your Fibonacci set up in such a way where if you're taking the high to the low, the deviations or whole number deviations, it's not a matter of exactly how many number up or down. It's looking for a confluence, and that's one of the things I was trying to impress upon you in the model number 5. So it's a confluence of not just one day, but at least 2 days worth of confluences within the construct of a bias. Okay, so in layman's terms, I'm going to walk you through it. We're looking for how this day went up higher. We're expecting it to go lower because it's inside a seasonal tendency. We're expecting for that daily low to be taken out, and we want to use some precision elements to get us in sync with that. So I'm measuring the high to the low, and then what I'm doing is I'm determining that 50% level between that high and that low. Then I'm dropping the fib from that to that, so it gives me the 50 levels. Okay, and the only reason why I'm doing it that way, and it may be confusing to you, is I want to have smaller standard deviations instead of like what would be otherwise from here to here. What I'm getting is from here to here, that's 50, so it gives me smaller increments of standard deviation. So you can see we have a standard deviation of -5 there. So we're looking for that in time. You can see we didn't get it. That's fine. We're going to work on that. Remember, standard deviations are within 3 to 5 pips. That's, in my opinion, the realm of error, okay, where it can be within that vicinity and still be good enough. And the standard deviation on the upside, same way. Looking for 74.89 for pipettes. And the high actually comes in at 74.93 and a half. So it's within 5 pips. Okay. The next trading day, this is where we're trying to take this setup. Same thing, we're using flout, using the rules with the standard deviations from central bank dealers range, Asian range, and flout. So same thing here. I'm showing you the sessions, London Open, New York Open. So we're looking for key turning points. We're looking for sell setups. What's the bias? It's bearish. We're aiming for a run below that low here. And we anticipate what? London creates an important high or a high of the day. And then it expands down into New York Open and potentially even later into London close. But we're using these 2 time zones, if you will, in terms of kill zones. And then we have the element of the London Open price action. So we want to get some measurements on this trading day that would give us the objectives for that fair value gap. So at 2 o'clock in the morning, it trades up into that fair value gap there, and we're expecting price to trade down. How far? Well, obviously, we're going to look for it to go below there. But let's add some precision to it. Standard deviation here to here, measured down, we have flat calling for negative 1.5. The level comes in at 73, 94, and 4 pipettes. That's what we're noting here. And if you look at the previous day's standard deviation, it's 73, 90, and 7. So again, within 5 pips variance. So we could split that range in half between this level and kind of aim for the midpoint, or we can just take that level here plus the spread, and that would be fine as an objective. But we can take the swing projection idea that I've taught you, high to low, and that projection of negative 1 comes in at 73, 92, and 1 pipette. That is the exact low of that candle, 73, 92, and 1 pipette. So we have a confluence of factors coming together within the New York kill zone, giving us a precise entry, precise exit, targeting initially the sell side liquidity over here. So when you walk through your day and you're looking for short-term trades or day trades and you're trying to determine what it is you're trying to aim for, obviously you have to have the bias. Okay, it's going to be framed on the higher time frame. When you're looking for these setups, you can use the London Open or New York Open kill zone. Preferably, if you can, try to do London Open. But if you don't have opportunity to be trading it, at least use London Open's kill zone setup as a kind of like a bias, or support to bias. If you were to use the New York setup, it would be this high, low, optimal trade entry. Right in here is your optimal trade entry. And you would look for a lower time frame area in here for fair value gap or something that would be a premium array. And it sells off, and you can use the same targets based on all the things I've outlined here. So when you're using standard deviations, this is one of the hardest things that the students have been able to come to grips with, because there's variables here, okay? So when we go through these standard deviations, you're doing multiple ones. So you're getting an idea where it could potentially go, and then you're going to have to determine which one you're going to pick. Now, I've shown many examples of this, okay? And if you go through your old data and you backtest, you'll see many instances of precision elements like this, that it's undeniable. But the problem is you want it to be easy, where it's just A, B, C, 1, 2, 3. It always works the same way. It's not going to be like that, okay? It's never going to be just that simple. So there's going to be a variable of measuring the wicks like I'm using, or using the bodies. And what you're doing is you're looking for which one of the ranges between the low and the high is giving you the most confluences between the previous day and the day you're trading. This is a Tuesday, so you're also building in the idea that maybe there was a high formed for the week here on Monday, and then on Tuesday you're looking for the rollover and continuation, because we already had a nice move away from that. So there's a lot of factors, obviously, with model number 5, but you can start to incorporate these elements in your other trades. If you're using another trading model, or if you're back testing, always try to do these measurements. Okay, and what will happen is you'll start getting better at it, because I didn't learn how to do this to sit one and done and knew how to do it. It's not how it worked. It took a lot of years of fine-tuning this, so that way I'm looking for certain things that repeat. You're not going to know all the time. Okay, all you need to know is a rough idea on the trades that you're looking to take. If it's going to be based on like intraday, either scalping or intraday, that's the only benefit really I think Model 5 is going to give you. Otherwise, you don't really need these things. There's other things that provide just as well, higher time frame objectives, that you don't need to be this precise. And if you're worrying about trying to be this precise, and that's like the only definition of you being successful here, you're missing the point, okay? If anything, this communicates the markets operate under an algorithm. And they refer to specific times for measurements for standard deviations above and below the market price within the context of the bias that would be expected, bullish or bearish. Okay, and then bringing in the elements of time. So the short here at the fair value gap, do you need this fib from here to give you that low? No, because you already know logically that you have relative equal lows over here. That's a first partial. And then below that low here, which is previous day's low, is sell side. So as soon as it hits that low and goes below it by 1 pip, that would be enough for you to consider an objective to cover the short. Do you need to be trying to get out at that price? No. But learn to study your previous moves, either by back testing or using it with your current trade to see if these ideas pan out. Over time, your precision and the appreciation for how these markets price and book will obviously increase over time. All right, so hopefully you found this one insightful. Until next time, be safe.